So, Open Door CEO announced in a blog post that the company has laid off about 550 employees. That's 18% of its workforce. And can you imagine getting the notification that you just lost your job from reading an online blog post or tweet on Twitter? Man, how has business evolved? Skyrocketing mortgage interest rates and inflation are taking most of the blame for the decreased demand that has led to slowdowns in business and companies like Open Door. The company CEO said that they are navigating one of the most challenging real estate markets in 40 years. After spending the last 6 months trying desperately to reduce its operating expenses, and that prior to this recent round of layoffs, they had already scaled back their capacity by over 830 positions, and made a point to say that they did not make the decision to downsize the team today lightly, but did so to ensure we could accomplish our mission for years to come. Now, remember when I told you guys about employees being the most expensive overhead operating expense for businesses, and how businesses are going to have to start budgeting better, tighter, and cutting back. So sales, revenue, and profit are the name of the game. And if you aren't producing that, then you're just a dragging anchor, and they will cut the line to save their own ass. So with that being said, more layoffs are coming. Prepare yourselves, folks, especially in real estate related businesses and industries. Now, on the bright side, the impacted employees are reported to receive 10 weeks of severance pay with an additional 2 weeks of pay for every full year beyond 2 years of tenure. But that money will disappear in the blink of an eye when you know that this is all you've got left. Inflation is gobbling up dollars at a rapid pace. And if you were on the list of folks who got the axe, then you know the clock is ticking. So a little bit of background on the company. Open Door went public in December of 2020 and closed its first day of trading on the NASDAQ stock exchange at $31.25. And that very same company today is now hovering somewhere around its 52-week low in the mid to low $2 per share range. Ouch. Can somebody say the writing is on the wall? And although this is not investment and financial advice, there's no way I could be buying in even at this extremely low and discounted price. And here's why. Open Door, along with several other companies, have been hit hard by the plummeting prices of homes across America and rising mortgage interest rates. At times considered by some to be the Amazon of homes, the company was trying to flip houses in a bubble and was ultimately just storing up trouble, facing near billion-dollar losses as rising interest rates are causing customers to pull back, leaving Open Door and others like them sitting on rapidly depreciating inventory. These once assets are now extreme liabilities. And when real estate is a liability, you know you're in deep shit. And thus, contributing factors behind Open Door shares collapsing by 90% on the stock exchange and with their bonds trading at distressed levels, this is what most would define as a crucible moment. Weak balance sheets remain a high worry for Open Door and the like. Having fallen victim to the cheap money era, low interest rates provided cheap capital to expand rapidly while helping customers afford increasingly expensive assets that they had no business owning in the first place. But, however, they were too slow to recognize that a storm was brewing, and so were the hedge funds that backed them. So between April and June of this year, Open Door purchased more than 14,000 houses, and thus paid top of the market prices for them. Ouch. And so now they're trying desperately to offload those homes as quickly as possible, kind of like a game of hot potato. But it appears that the damage has already been done. After recently Open Door announced a $573 million impairment for anticipated losses, and with much concern as a majority of those high-priced houses still remaining on their books. So the Open Door business model was all too risky, especially in such a volatile environment. And the company has plans to facilitate more home sales by including increased interest from institutional buyers. Oh boy.